one aspect of this that always interests me is that Brookfield, being a big investor, clearly sees a very significant long-term future for Origin. It also says it's prepared to put an extra $20 billion into the company to basically help to fund the energy transition. So that being the case, Australian shareholders could technically also do that and therefore enjoy the future dividends from the energy transition. And that, you sense, might be a bit behind where AustralianSuper's thinking right now.
Yeah, that's right. Origin already plans to invest a lot of money in renewable energy and batteries. It's got a very strong balance sheet nowadays, so it is actually pretty well placed. So you can argue Brookfield might do more of it, but certainly Origin and its investors are going to do quite a lot on their own.
So Brookfield and EIG, being a private equity player, effectively a big investment fund, now we see the trend for Australian superannuation funds to even take companies off the stock exchange. Think Sydney Airport as being one classic example of that. But the big issue here is, of course, if they let this go to Brookfield, then AustralianSuper and other big Australian superannuation funds have fewer opportunities to invest in to get those same benefits.
Yeah, that's right. And so I guess they're incentivized not to give it away too cheaply.
So that is true. All right, then go to Origin itself, because Origin is going through something of a transition itself as it moves more to the renewable energy. And the Eraring power station has got, a deadline for when it will close. So its own performance yesterday showed that compared with this time last year, some of its gas sales were down, some of the prices were down. But that, of course, is the here and now. It's not where it goes to in the future.
Yeah, that's right. I wouldn't worry too much about one quarter. I think, earnings guidance was provided at the last results, and it shows that profits should be up by a decent amount in FY24. So, things are going pretty well overall for the business.
Okay, so then just explain to me what Origin looks like if it is not taken over. You say it's already got plans to invest, but is it a different business? Is it an emboldened business? Does it have to go faster, grow faster to satisfy shareholders who have said no to this takeover offer?
I don't think they will change their strategy that much. They already had a strategy of transitioning to renewable energy. So the coal-fired power station will close down sometime over the medium term. They're building more renewable energy, batteries, perhaps even pumped hydro over the longer term. So I think they'll just continue with that strategy. It's the same strategy as AGL. It's supported by banks. It's supported by the government. So I think that's the way they'll go. And they should have pretty good support from their investors if they need to raise money. Though it's not my base case. I think they're pretty strong balance sheet. They can fund a lot of that investment by themselves.
So just a quick and final one. You see, say, Mike Cannon-Brookes buying into AGL. You see Brookfield originally have a go with him at AGL and then suddenly withdraws and then goes for Origin itself. When this energy transition goes through, it does sort of tell you, doesn't it, that some of the smart minds believe that there's decent returns long term in this very sector where right now there have been historically problems.
Yeah, I guess it does, because there is a tremendous amount of money that needs to be invested, and you expect a decent return on that. I guess what that means for us, the ratepayers, is it's probably going to be higher for longer in terms of electricity prices.
There you go. Adrian Atkins, Senior Equity Analyst at Morningstar. Many thanks for your time on the program today.
No problem.